So without further ado, oh, by the way, questions. We've got a lot of content to cover. So I might not have a chance to answer your questions in the session. Just use the chat button. If I don't answer it in the session, I'll definitely answer it in writing after we finish. And then if you have more questions, of course, you can also reach out to me directly. My email address is simon@sha.co.za. And I'll get back to you as soon as I can. So when it comes to D&O, I think probably the best place to start is just to talk about what it actually is. So the first thing you need to remember is that it's a policy like any other commercial policy. It's actually bought by the company. So when you're out there selling, you're going to be selling it to the business. But unlike the other commercial policies, this one is there to actually protect the directors and officers who are generally senior managers in the business. It's to protect them in their personal capacity. So even though the policy is in the name of the business, the actual beneficiaries of that policy are the individuals. And that really makes it different to any of the other commercial liability products that are out there. It doesn't only cover current directors, it also covers past directors. And that's quite important to note, particularly if it's a listed company, but it could also be a privately owned business. And that means that directors that have retired would still be covered for the actions that they took while they were sitting on the board or sitting in the management team. And again, important just to make a mental note, I'm going to talk about the retroactive date because it is a claims made policy. But that's important to remember because if you're covering past directors who may have retired, you of course want to make sure that the retroactive date is set accurately so that they still have cover. If you set the retroactive date to today, then any of the past directors are obviously not going to have any cover. So just keep that in mind. When we talk about directors and officers, it is a liability policy, so it responds to threats of litigation or lawsuits. So the directors of the business may be sued, and I'll tell you who could sue them a little bit later in the presentation. But they can be sued for what we call wrongful acts. That's how we define it under the policy. So if you can imagine a D&O policy being very similar to a PI policy, it's really covering the negligence of the directors as business leaders. Whenever I refer to directors, you can also include senior managers in that because they're also covered by the policy. We don't name these people in the policy. So anybody that is sitting on the board or is in a senior management or supervisory position would effectively be able to enjoy the benefits of the cover. I'll go into more detail now as to what is actually covered and how a director could actually be sued by some person or third party. So when we talk about the cover responding to a wrongful act, we need to just understand what do we mean by these wrongful acts. So there's a list on the screen right now, but probably the most important is a breach of duty. So where the director has a duty to the company, so they're employed by the business, maybe not as employees, they might be executive or non-executive directors, but they are there to fulfill certain duties that have been thrust upon them by the Companies Act. And I'm going to tell you what those duties are in a moment. Also important to remember is that the policy also covers employment practices liability. Now, this is different to, I don't know if any of you have been exposed to this type of cover in the past. Employment practices liability generally protects the business if an employee takes the company to the CCMA or the labor court. So when somebody is fired from their job, they might allege that they've been unfairly dismissed and they would approach the CCMA. Now, there is employment practices cover under a D&O policy as well, but it doesn't protect the company. Remember, we must always come back to this issue that we are covering the individuals, the individual directors. Now, 90% of the cases that go to the CCMA, in fact, 100% of cases at the CCMA are between the employer and the employee. And the employer is not the director. The employer is the business. The only time we see directors being taken to court for employment-related issues is where they may have been directly involved in sexual harassment or discrimination actions. So that is the only time that you actually see an employment-related claim being brought against the directors in their personal capacity. If you've got clients out there that are worried about CCMA activity, they should get a standalone employment practices policy. At SHA, we have an employment practices liability extension that goes into our liability policies. You do pay for it, but that's the one that protects the company's interests rather than the director in their personal capacity. So every time you think D&O, you think, okay, this is there to protect the business, to protect the directors and not the business. The business has its own cover under liability, PI, employment practices, and all the other commercial insurance products that are available. So let's look at what a director's duties actually are. In terms of the Companies Act, it says that they've got to exercise reasonable care, skill, and diligence. They've always got to act in the best interests of the company, and they must act within their powers and for a proper purpose. So if they start acting outside of the powers that have been granted to them, that could be perceived as a wrongful act. They have to exercise independent judgment. In other words, they shouldn't be influenced by other things that don't have the company's interests at heart. So what we've seen a lot of in South Africa over the last 10 years, not just at state level, as in the state capture issues, but even in the private sector, where you've had directors not acting in the interests of the business, and they've been making decisions based on their own personal interests. And that's where your bribes and corruption creep in. Directors and officers' policies don't cover criminal acts, but what they do is if a director is alleged to have committed a crime, let's say fraud, the policy would actually respond by defending the director. But as soon as the director is found guilty by a court, the cover would be pulled back, and in fact, the underwriters would seek to recover the legal costs that they've spent. So someone that is alleged to have taken a bribe, for instance, would initially enjoy legal defense cover under the policy, but as soon as they're found guilty, the cover stops, and the underwriters will try and recover those costs from the director. But that has to go through the court process. Conflict of interest is extremely important. And you'll see later on when I talk about risk management, that directors who make decisions out of their own interest, often businesses are not forcing directors to sign conflict of interest documents. We have to do that at Santam. Every year we have to sign a conflict of interest declaration. But a lot of businesses in the private sector and at state level don't do that. And of course, that is one of the reasons why we're seeing an increase in conflict of interest incidents and losses. And then your corruption and bribery is obviously not to accept benefits from third parties. So that's really what the director's duties are. The list is quite short, but if you just look at how that applies in business, there's a broad range of activities that any director has to get involved in. They're making business decisions all the time. So the kind of claims we see are where directors ought to have known something, but they don't know it. They make a mistake, and then some third party suffers a loss. It could be a customer, a supplier, It could be even an employee that loses their job because the company's gone under because of a bad decision that was taken by the director. So when we look at those wrongful acts, that will tell us whether or not the director is going to have cover under the policy. Sounds complicated right now. Hopefully it'll become clearer to you as we go through the presentation. Who should have this? Well, the board, obviously, including the former directors and the company secretary. Prescribed officers as defined in the Companies Act, that's your senior managers. And a new one that has just been created on the 1st of July in the POPI Act is the information officer. And what we're seeing, a lot of brokers are giving us feedback that they're being more successful in selling D&O cover because there is this new information officer role. This person, if there's a security breach or a privacy breach at a company, could actually face jail time and a significant fine. So they should actually have D&O. They would automatically be covered under the D&O policy. So if you've got a client that's going, well, I don't know whether I should have D&O, and you've been having those conversations at renewal, they have to appoint an information officer in terms of the POPI Act, and that person has substantial liability, which could be protected under a D&O policy. So that is something important to remember from a sales perspective. You have other committees in the business, like the audit committee in bigger companies. They would also automatically be covered by the D&O policy. And there's your managerial and supervisory employees that I was talking about earlier. Most D&O policies have 3 sections to them, or 3 sides, as it's referred to in the wording. I'm not going to spend too much detail here. I think most of the clients that you're dealing with in your business are probably not listed companies, but more privately owned. So side C, which is actually where the company has some protection under the D&O against securities claims. Those would normally be related to the listing of shares on the stock market. The ones that we need to focus on in the private sector or in privately owned companies are A and B. So A is the big part of the cover. That's directors are covered in their personal capacity. We pay their legal costs either to them or to their attorneys, and we pay the damages obviously to the third party. Side B, it says who is covered, company. Now that might be at odds with what I told you earlier, but let me explain. In some businesses, the company agrees that it will pay the legal costs of the directors, and then the company recovers that from the D&O. So the ultimate beneficiary is still the director. It's just that we allow the policy to reimburse the company if they've already indemnified the directors. So it's very simple. Core of it is still the ultimate beneficiary is the director or officer of the business. These policies are written on a claims made basis, so the claim must be made, the incident that gives rise to the claim must have occurred during the policy period after the retroactive date, and the claim must be submitted during the policy period as well. So it's very important that the retroactive date is set correctly. If you change insurers, just like with any other liability policy, very important that you keep the same retroactive date that you had on the original policy. It also means that those past directors who may have retired or left the business are still going to enjoy cover for the decisions that they took while they were still sitting on the board. I also just want to pause here on the issue of limits. I get asked all the time, what is the appropriate limit that a company should take on a D&O policy? We don't normally give a specific number because, I mean, how long is a piece of string? You would have heard that so many times. But these are the things to keep in mind when you're thinking about the limit. Firstly, the limit is aggregated. Okay, so there's a single limit that applies to the whole year. So if you choose 10 million Rand, and you have 2 claims of 10 million, you're going to run out of cover. The other thing with this aggregate limit is that it is shared amongst all of the directors and officers. They don't have 10 million each. So it means that if you've got a big board or a large company and they're buying a small limit of 5 or 10 million, if they have a claim where all of the directors are implicated, it's likely that you're going to run out of insurance cover. I was just involved in a claims meeting yesterday. It's a big business. It's a listed company. We've already spent 18 million rand on legal fees because each director on the board has their own attorney. So, you've got like 12 people all racking up legal fees. So it's very important to remember that the bigger the business gets and the more directors and officers that you have, the more likely it is that the limit's going to be eroded. So that's the first thing. Bigger limits for bigger boards. The other way that one can look at the limit is to say, well, where are the claims going to come from? We're going to talk about that a little bit later. If it's a listed company, generally the claims come from shareholders. And the lawsuit would relate to the drop in shareholder value. In other words, my shares were worth 100 Rand. You made a bad decision. Now they're worth 50 Rand. I'm going to claim that 50 Rand that I lost from you in your personal capacity. So generally, we look at the asset value of the business because that gives us some idea of what the value of the company is. Not an exact science, obviously. So bigger businesses should have bigger limits. Listed companies should have bigger limits. I don't recommend that any business has a limit lower than 15 million, even in an SME. The legal fees rack up so quickly in D&O claims because we generally have to get expert witnesses involved, often accountants, CAs, forensic specialists. So you can really start eroding the limit quite quickly. But key point on this slide is just to remember that the directors are sharing this limit amongst themselves. So you can run out of cover quite quickly if you've got a small limit. What are the exclusions? I'd say the one that gets triggered most often is that top one, which is your criminal acts, basically, your intentional, fraudulent, dishonest, willful, or deliberate actions. Remember what I said earlier? This is called a conduct exclusion. So we will allow the case to run until it's been proved that there was intentional, fraudulent, dishonest, willful, or deliberate actions. So it's not that we sit as underwriters and go, well, we think you did it, so there's no cover. We advance the legal defense costs, and then we pull back on that if guilt has been established. Where there's been personal profit gained by a director, which they weren't entitled, that's not covered. Anything that's against public policy or contra bono mores, that is also not covered. Professional duties. So remember, a PI policy covers the company's interests when it relates to professional advice. So if you're a firm of attorneys or a firm of accountants, you need a PI policy to cover that. This is covering the business leaders against their management decisions. It doesn't really have anything to do with the business's activities or its services that they're providing to third parties. That is dealt with under PI or liability. No commissions or bribes, but again, remember the conduct exclusion that we spoke about. We don't cover retirement fund trustees in these policies because pension fund trustees liability policies cover that. Some policies have an exclusion for major shareholder litigation. So this is where, particularly in a privately owned company, the only director is also the major shareholder. So you might find the underwriters saying, okay, well, we're going to exclude any lawsuits coming from the major shareholder against the director because it's the same person. Or the major shareholder may have an influence on how the business is actually run. But these exclusions can be removed from the policy. And in fact, what I've seen over the years is that less and less policies have this in there. It doesn't mean that if you're the owner of the business, you're the major shareholder, that you have no cover. It means you can't sue yourself. But if someone else sues you, that would still be covered because you're acting as a director of the business and not as the major shareholder. And then, of course, some policies also have an exclusion where one director sues another. And this is, of course, to prevent directors making a decision as a board and then afterwards somebody going, well, I didn't really agree with you, so I'm going to sue you in your personal capacity. So those are your key exclusions. There are some others related to terrorism, etc., but not necessary for us to go into those at this stage. Please remember, if you have questions, post them in the chat. I can't see the chat while I'm presenting, so I will have a look at it when we get to the end of the presentation. Where do claims come from? Wow, well, the Companies Act says any stakeholder, and that can be, it can literally be anyone. It could be the community. Directors can get sued by the community, often where there's environmental issues. It could be a competitor. It could be a creditor, in other words, the bank. We have seen an increase in claims brought by creditors against directors when the company has gone insolvent. And I think this is also important to remember, because what happens is, I mean, you would know if you studied any finance, maybe in your insurance studies or BComs, etc. You'll remember that, you know, we were all taught, if you want to set up a business, you must set up a PTY Limited, because then your assets are separate from the companies and so are the liabilities, which meant that if the company went insolvent, the creditors could not go after the directors in their personal capacity. So how then could a creditor bring an action against the directors when the company goes under? What the Companies Act does is it says if you failed in your duties as a director, a door is opened to the creditors to come after you in your personal capacity. So in the ordinary course of events, your liabilities are separate from the company's. But if the creditor can show that you've made an error in judgment, you failed in your duties, they could come after you in your personal capacity. And we're seeing an increase in those types of claims, because what happens is the creditors say, you know, you should have known that going into this new business venture at this late stage was going to lead to problems. The business has now gone under, and we're going to come after you in your personal capacity. Something we're still expecting to see coming out of the pandemic. I've got some slides that talk about COVID a little bit later. Is where a creditor could say, at some point during the lockdown, you as a business had the opportunity to pivot into another business type. You could have turned your factory, your clothing factory into a factory that manufactures masks. Lots of businesses did that. You made a decision not to do that. And now the company has been declared insolvent or has gone bankrupt. So we are going to go after you in your personal capacity. So those are the kind of doors that get opened when a creditor alleges that the directors failed in their fiduciary duties. An employee can also bring an action against the director. Now, this is nothing to do with the unfair dismissals, etc., that we spoke about earlier. If the employees lose their jobs because the directors made bad business decisions, so it's not dismissing someone unfairly. Again, the director could have made a decision to pivot the business to keep it going during the lockdown. They failed to do that. The company is closed down, and the employees are saying, we know that you had an opportunity to save this company and you didn't do anything about it. We're coming after you in your personal capacity. It would be covered by the D&O policy as well. But generally, anyone who suffered a loss because the directors have breached their duties or failed in their duties, could bring a claim against them. How does it work in practice? Generally, it's alleged that the director failed to perform their duties. This third party or the employee decides to sue the director in their personal capacity. A summons or letter of demand arrives. They would hopefully then let you know that they've received this summons. Timing is obviously critical here. We must be notified as soon as possible. If the claim is covered in terms of the policy wordings, we immediately start paying those legal defense costs. I would say it has changed slightly over the last 2 years, but I would say probably 80 to 90% of D&O claims amount to nothing more than legal defense costs. Often we are able to prove that the directors did not fail in their duties, but we have seen a couple of damages claims creeping in. So when the directors say, nobody's going to sue me, or, the way we conduct business, we don't need a D&O policy, you need a defense costs policy. D&O cover is still relatively inexpensive for privately owned companies, and it's like having access to a little war chest that you can dig into to get proper legal defense. We also have an expert panel of attorneys. If it's a privately owned company, you don't really want the director rushing off and appointing his brother-in-law that did his marriage contract or his property transfer. You want someone who specializes in corporate governance type claims, and we have that panel of attorney. Although we don't force the directors to use our attorneys. I'm going to share some stats with you. This came out of our 2020 annual risk review. If you don't have a copy of this document in its entirety, please send me an email, simon@sha.co.za, and I'll send you a copy of the risk review. These are some excerpts that related to D&O. One of the questions we asked is, what did you perceive as a business leader as the biggest threat to your business? Obviously, this question was being asked right in the heart of the lockdown. So insolvency was a big thing that especially smaller businesses were worried about. Reputational damage, fraud by employees, and cyber attack were kind of, almost in a tied second position there. If we ask the question again this year, which we're just about to start with our next annual risk review, I'm pretty sure that cyber will have moved up the list significantly. We also, because businesses were worried about insolvency, we said if your business was in financial trouble, at what point would you apply for business rescue? And as you can see, 51% of directors had a pretty good idea as to when they should do it. As soon as it became evident that the company couldn't pay its debts, that was the right answer. The other answers below this are quite worrying. You've got 49% of directors saying that they don't actually know when they should initiate business rescue. And that is tricky, because if you do it too late, then it's just a delaying tactic. And in fact, the business rescue will fail. It's been shown that business rescue that's initiated early on, in other words, as soon as the directors realize they don't have enough money to pay the upcoming debts, often the business rescue practitioners can save that business. We also asked the directors, about 1,000 people took part in the survey. 27% said of those that had a risk committee, that they don't share the minutes of those meetings with their insurers. And they said, you can see here, 52% of directors said they don't share those details because it contains sensitive and confidential information. And this, for me, is an issue related. There's a trust deficit between us as insurers and our clients. And this has, of course, been exacerbated by the fallout from the pandemic with the contingent business interruption claims. We have to work very hard to get our clients to understand why the more information they share with us, the more likely it is that we can put the right cover in place and that there's not going to be an issue at claim time, and we're not going to have non-disclosure issues. Risk registers and audit committee meeting minutes give us a lot of insight into what the directors themselves are worrying about, which can really give us all a heads up on how the policy should respond and how it should be structured. Less than 50% of directors sign conflict of interest documents. As I said earlier, that's a bit of a worry because we see a lot of claims coming out where the director has a clear conflict of interest and hasn't acted in the interests of the business. 46% of businesses don't even do criminal background checks on directors, which is strange because most businesses do on employees. Less than 20% do lifestyle audits. This is something new that we're starting to see happening, particularly in bigger companies. And that's really an early warning signal for corruption or bribes, etc. But not a lot of companies are doing that at the moment. That is something we expect to change going forward. What about claims activity? We spoke to 300 brokers. 14% said they'd noticed an increase in claims notifications. This is a little bit lower than our own experience. We've seen, I'd say, closer to a 20% increase in claims notifications over the past 24 months. But since 2016, our legal fee spend on D&Os increased by 56%. That way outstrips inflation. So not only are legal fees rising, but we're finding that the cases are becoming more difficult to defend. I chatted to Anton Meyer, who's our head of claims, yesterday when I was preparing for this talk. And he said, one of the issues we're finding with directors is, and we see the same thing with professionals, it's really a reputational issue. So the director is often unwilling to settle. They would spend every last cent of the limit on legal fees because they want to save their reputation. Of course, we respect that. But often we have to sit with our clients and say, look, this is a no-win situation here. You're going to run out of cover and you're not going to have any limit left for the damages if we continue down this road. So we have to keep an open conversation going while the claim is running. It sounds logical, but these claims can take 5 years from the time that they're first notified until they run through the court system. And things can fall into gaps, which is why as brokers, it's very important that you stay on top of the claim, even after it's been reported. We obviously send out reminders, but we don't ever chase a third party for additional information because the strategy, of course, for all liability underwriters is to let sleeping dogs lie and the claim might prescribe against the director. So it is important just to keep a watchful eye on these claims. And to make sure that if anything's changed in the business or they've received more documents, that those are passed on to the underwriter. But as I said, we've just spent 18, probably closer to 19 million on another case in a listed entity. Smaller businesses easily ringing up 1-2 million rand in legal fees before you can even blink. It's quite scary. What the attorneys are charging these days. I'm not going to spend too much time talking about COVID. I think you all know which sectors were most affected by the pandemic. This had an overall economic impact on business. Now, directors aren't to blame if the company goes insolvent because of COVID, but they were expected to manage the crisis as they are expected to manage any crisis. So that would be looking at the people element, looking at the finances of the business. If there are regulations, which we know there are related to COVID, particularly around safety, and what operational issues needed to be looked at to keep the business running. That's what the director had to do in the face of COVID-19. Not an easy task if you think about all the confusion that was going around. We haven't seen any claims coming directly out of the pandemic. There are no COVID exclusions on D&O policies, or certainly not at SHA. So these are the kind of things you could expect, where there have been retrenchments, so employment practices violations, where there's been allegations of mismanagement or failure to act in the crisis, where there wasn't proper contingency planning in place. You could almost forgive the fact that, in the first 3 months of the pandemic, we all thought that lockdown was going to end after that. But once we got closer to the end of the first 3 months, we realized we were going to be in this for a lot longer. So you would expect directors to have had contingency planning at that point. And if they didn't, they do open up the door to litigation. Cybersecurity, I do have some slides on that. We saw an escalation in cyber attacks during lockdown for a variety of reasons. Enlisted companies failing to make adequate disclosures. In other words, failing to tell the shareholders what the true impact of the pandemic was on the business. Trying to make people feel more comfortable, but withholding information that could have made people go, I need to reevaluate my investment in this business. That could also lead to D&O claims. And of course, the failure to purchase insurance. If insurance was available for something and the directors decided not to take it up, they could find themselves being sued by shareholders or other interested parties. We haven't seen any claims for these things, but important to just keep a watchful eye, because we're not through the pandemic yet, and we certainly haven't seen the end of the economic impact. I'm not going to deal with this slide right now. Related to cyber, we saw a significant spike in cyber attacks. Before COVID hit, we already, 30% of the 1,000 businesses we spoke to said that they'd already had a cyber attack in the preceding 24 months. This went up dramatically during the pandemic, and this was largely due to the fact that everyone was working remotely who could. Often employees were using their own devices, so they had unsecured computer equipment. We saw an increase in phishing attacks because the cyber criminals knew that people were working at home, often on their own devices, and often a little bit more complacent because they weren't in the office environment and the local IT guy wasn't available for them to just, go and chat to. And generally, there was a lack of awareness. Everyone was watching CNN with one eye and working with the other, and very difficult to focus, which meant people were clicking on things that they shouldn't have been. And of course, this just led to a dramatic increase in cyber. We've seen a massive increase in the sale of cyber insurance as we've come through the pandemic. Some of that has to do with the media attention around cyber. You saw there was a massive cyber attack at Transnet a couple of weeks back. But this is kind of a daily thing that we're seeing in the news media at the moment. When we talk cyber and directors, there's a connection here because the directors have a responsibility to understand what the company's cyber exposure is, and they have a responsibility to implement security measures to make sure the business doesn't fall victim to a cyber attack. And that's where the overlap is, because the two covers should actually be sold together. Remember, the difference is cyber policies cover the company against cyber-related incidents. The D&O policy covers the directors against their failure to carry out their duties. And one of those duties is managing the cyber exposure. So you could have a cyber attack against the company, where, they're offline for a couple of weeks, like what happened to Transnet. And then you could have shareholders suing the directors in their personal capacity because they failed to understand what the true cyber exposure was of the business, and they didn't put the right things in place to prevent it. So those two products work quite nicely together. The cyber product does not cover the directors in their personal capacity. So there's no overlap, but there's a nice plug-in between the two covers. Unfortunately, most businesses, and bear in mind, there's a moving target. This data is over a year old now. Many clients believe they don't have a cyber exposure. It's our job to educate them that every business that has any kind of online presence or uses any kind of technology has a cyber exposure. I'm happy to do a cyber talk with all of you separately. I don't want to go into too much detail. But look at this stat on the right-hand side of the screen. So a year ago, out of the 1,000 businesses that we spoke to, 58%, these were mostly SMEs, said that they didn't have a broker that discusses cyber insurance with them. That is disturbing, but also an incredible opportunity. I'm sure all of you on this call right now are actually talking to your clients about cyber. So what's the road ahead looking like for directors? Well, we can expect that the economic downturn is going to continue for a while. That means they're going to have to be thinking on their feet as to how they keep their businesses going. We've seen an increase in business rescue. There are definitely more liquidations and insolvencies. In a quarterly report that we produced at the end of the second quarter of the year, in our SME portfolio, we had 126 cancellations of cover for SMEs. Something like, I can't remember the exact number, but 28 of those 126 policies were lapsed because the owner of the business had died during the pandemic. Frightening, absolutely frightening. And the business had subsequently closed. So those are all obviously hangovers from COVID that we're still going to have to deal with. D&O prices are going up, although I have to say that's more in the mid to large sector. SMEs in particular can still get very good rates on D&O because they don't have a lot of claims activity in that area, and it is largely legal defense costs. But we are seeing an increase across the board in claims activity. I just want to finish off with some myths. So these are just based on some of the frequently asked questions that we get from brokers or from clients. Non-profit companies are exposed to the same kind of D&O as general PTY limiteds. So it's a misconception that non-profit companies don't have any need for D&O. And if you think about it, someone said to me, no good deed goes unpunished. You ever heard that saying? And it's really true in non-profits, because often the directors or board members or steering committee members are doing it free of charge. They're working on these NPCs because they want to do something good. But that doesn't mean they don't have liability in terms of the Companies Act. The company will always indemnify me or hold me harmless. That is also incorrect. I'm a non-executive director. In other words, I'm not an employee of the company, so I can't be sued. That is obviously incorrect. I'm a director and only shareholder of a private company and not exposed. Not correct. Because other stakeholders, other than shareholders, could be creditors, could be SARS, could be employees, could be the local community. They can still have a go at you, even though you're the business owner and the only director of the company. The costs of actions are prohibitive. In other words, it costs too much money for someone to take me to court. They won't be able to afford an attorney. That's wrong, because we now see that attorneys are charging contingency fees. In other words, they agree with the third party that they will only bill them if they win the case. And that is definitely driving claims, not just in D&O, but across all specialist lines. I'm no longer employed by the company, or I'm no longer a director of the company. We've already spoken about past directorships. The company has a liability or PI policy that will pay. That covers the company's interests, not the directors in their personal capacity for their decisions that they take as business leaders. It's a completely separate type of cover. Finally, what do we look at as underwriters? These are the things we generally ask for. Now, I'll start with SMEs. On our Pocket Underwriter, which is our digital platform, we don't ask for a dated and signed proposal form. There's a couple of yes/no questions that need to be answered. It's very simple. And we don't ask for a copy of the financials either. So that's generally where the business has an asset value below 250 million, and the limit that's being requested is below 20. Bigger businesses need to provide us with a proper proposal form and a copy of financial statements. If it's a new business, in other words, a startup, they won't have financials yet, but then we might ask to see the business plan, including their financial forecast, and we'd obviously want to see the CVs of the directors, just so we can get a feel for their experience level. That's actually the end of the slides.